Giving thanks for what we've been through, for downs as well as ups, and for the opportunities yet ahead of us. This is a special Thanksgiving edition of Bloomberg Wall Street Week. I'm David Weston. This week, America celebrates that holiday known as Thanksgiving, when we gather with family and friends, remembering a time nearly 400 years ago when British settlers feasted to celebrate their survival and to give thanks to the American Indians who'd made it possible. This year, most of us can be thankful that we haven't had to survive scenarios anything like those early Massachusetts colonists, though we are mindful of all those who have lost loved ones to the pandemic over the last 3 years.
We all lost something, a collective suffering, a collective sacrifice, a year filled with the loss of life and the loss of living.
And to Ukrainians who have spent most of the year valiantly fighting off Russian invaders at a great cost of blood and treasure.
We will not give up. We will not lose. We will fight till the end. At sea, in the air, we will continue fighting for our land, whatever the cost.
But for the rest of us, it has been a year of great uncertainty as the economy has come back, but at the cost of mounting inflation.
Inflation is extremely high. The levels we're at were unimaginable 18 months ago. And so we have to get that under control.
And the beginning of belt tightening that has played havoc with the plans of so many, as reflected in markets that have struggled week to week. One of the places on global Wall Street particularly hard hit by the higher rates and greater uncertainty has been mergers and acquisitions. And we sat down with one of the consummate deal makers, Sam Zell, to talk about the climate and how it's affected his business. Let's talk about what an investor does in this new environment of increased inflation and increased interest rates. First of all, tell me what's going on with your company. Are you seeing less deal flow?
No, just the opposite. We're seeing more deal flow. We're seeing more situations where companies are having difficulty figuring out what to do. We're seeing situations where 9 months ago, financing a transaction of XYZ size was nothing. It was, as you said, money was free. What's changed dramatically, think about the impact of the doubling of interest rates in 8 weeks. Doubling, it's just 8 weeks earlier, interest rates were 2.5 to 3, and now they're 5.5 to 6. That's an enormous change, and it's going to slow down everybody's activity. It's going to, for sure, impact getting deals done. But in our particular case, because frankly, I've oftentimes told the world that, when I'm liquid, the stock market can't go down. It only goes down when I'm illiquid. And here I am sitting there with a level of liquidity I've never experienced in my life, because my focus for the last 3.5 years has been on nothing more important than liquidity.
So you've got a significant deal flow. If anything, it's bigger than it was before. What about the quality of the deals? Are they different from what they were, for example, pre-pandemic?
I think they are, because I think they're a little more realistic. I think in pre-pandemic, when money was free, there were transactions. The whole SPAC market was we did a SPAC and chose not to take it to the next level, because when we did the SPAC seemed like a very interesting way to, in effect, monetize opportunity. It very quickly became a highly speculative scenario dependent on preposterous valuations that ultimately led to the crash of the whole SPAC market. World has changed a lot since then. And the change is basically modifying what you can do. On the other hand, there's always demand for capital, and there's always that demand is always on the shoulders of those that have preserved liquidity.
So let's talk about some specific investment opportunities. Energy. Yeah, I mean, you know energy terribly well.
Yes.
Do you see opportunities in energy right now? There's been a lot of tumult in the marketplace because of Russia and Ukraine and all sorts of reasons.
Yeah, I mean, we continue to do something in the energy space, not as much as I would have thought when this period began. The volatility in the energy space has been so extreme. I mean, just think about it. Within a 12-month period, the price of oil, vacillated between 30 and 120. That's an incredible level of volatility. Makes making investments extraordinarily difficult and challenging.
Do you see a prospect of a little less volatility? Because you have on the one plus OPEC plus trying to limit things. Now you got the U.S. government, which if it's not trying to regulate the price of oil, it looks kind of like it is because it says
Sure.
when it's going to sell and when it's going to buy. So it looks like it's got a bid and ask price.
Yeah, but we also have we also have an administration that's very anti-oil, and in my judgment, that anti-oil provision is only going to hurt the United States. I mean, we were producing 11 million barrels a day of oil. I don't know what we're doing now, but I think it's down 2 or 3 million barrels a day, as we've cut back on capital for fracking, et cetera. Not a healthy set of circumstances.
Now, the oil companies almost invariably say it's because of the administration, because of regulation, and their move toward renewables, things like that, so they don't want to make the investments. The administration says, no, no, no. You could simply make the investments. The problem is that your investors want it returned to them, that it's really a market phenomenon. It's not the government.
I'm sorry, I don't. I mean, I've heard that speech made by the government. I don't believe that in the least. I think what we have is we have a eco-friendly government that doesn't understand that even if there is a future of non-fossil fuel future, the idea that it's going to happen in 15 years, I mean, talk about sunk cost. I mean, it just doesn't make any sense. And so we're in effect creating a shortage by virtue of depleting depleting capital into the fossil fuel area that creates inflation that it just doesn't make any sense.
Sam, as I recall, you bought some distressed assets in oil back in 2019, thereabouts.
That's correct.
Did that turn out to be a good deal given how badly we need the oil now?
Probably 50-50. In other words, again, it didn't do as well as we expected because the volatility in that commodity was just beyond belief. I mean, nobody had ever seen that happen before.
Are you interested in nuclear? I mean, a lot of people say we can't get to where we want to go without some nuclear component.
Yeah, I personally agree with that. It's like cryptocurrency. It's one of those areas where I don't understand it well enough to be able to invest in it.
But given the difficulties with fiat currencies you've identified, I understand you have bought some gold, not a lot.
Yes. It's the first time in my life over the last few years I've bought gold securities and actually bought hard gold.
And are you a buyer going forward?
I'm not sure. I bought it kind of as my own definition of a hedge. I haven't done well with it. I haven't lost on it, but in a world where I think fiat currencies are being massacred or hurt, I think in that kind of a world, more focus on some hard currency is relevant.
You're very much identified in a lot of people's minds with real estate. As I recall, you started that maybe when you were in law school at the University of Michigan on the
Undergraduate.
side. Undergraduate, University of Michigan. So talk to me about real estate, where we are right now. We've got some record high rent prices. We've got mortgage rates going up. Tell us your view on the real estate market right now.
For all practical purposes, I haven't bought anything in 10 years. And where the opportunity has created, I've sold it a lot. I felt that the real estate market generally has been overpriced, particularly on the private sector, as opposed to, I think the public markets have actually done a very good job of sensitizing people to what's going on in real estate. On the private side, I mean, we took over a public REIT 7 years ago with, I think it was $13 billion of assets. We bought nothing with that portfolio and sold 142 out of 145 properties. What's really incredible is we sold 142 properties, and I don't have one sense of regret. Not one of those deals do I say, geez, I wish we hadn't done that or waited in the, if anything, we should have sold it faster, earlier, quicker, because it was because of free money. It created a price structure that, frankly, was very disadvantageous to the buyer.
That was Sam Zell, founder and chairman of Equity Group Investments. Coming up, we'll turn to energy and the quest to get more of it with less emissions with Todd Whitman, former EPA administrator and former governor of New Jersey. That's next on this special Thanksgiving edition of Wall Street Week on Bloomberg. This is a special Thanksgiving edition of Wall Street Week. I'm David Weston. Energy has been much on the minds of Wall Street this year as Russia's war in Ukraine made the price of natural gas spike up.
The president gets it. He's been working to get gas prices down. So as a result, they've been coming down for the last 3 weeks or so. But we understand that that's partially due to the war in Ukraine, and we need to keep oil on the market.
And President Biden tried to keep the price of gasoline down by releases from the Strategic Petroleum Reserve.
Additional 15 million barrels for December out of the SPR.
But the president was doing this even as he tried to continue his push for more investment in energy sources that didn't add to carbon emissions.
We're proving that good climate policy is good economic policy. It's a strong foundation for durable, resilient, inclusive economic growth.
Much of Mr. Biden's effort was focused on renewables like wind and solar. But many of those who take the zero emissions goal seriously agree that we can't get there ultimately without nuclear energy. One of those who's been consistently advocating for the role of nuclear energy is Todd Whitman, former governor of New Jersey and former administrator of the EPA. And Governor Whitman joined us on Wall Street Week to explain how it could work. You've dealt with nuclear energy for years now, so give us your sense of the role of nuclear energy potentially in getting to net zero.
Well, I think nuclear can play a huge role, at least in the transition from fossil fuels to renewables. Renewables are not yet base energy. They're peak shaving, and we're a 24/7 society, as is the rest of the world. The world is 24/7. And nuclear is the only form of base power that releases no regulated pollutants or greenhouse gases while it's producing power. And we have an incredible safety record here in this country on nuclear, and actually with few, obviously, very huge exceptions, being Chernobyl and what happened in Fukushima Daiichi. Overall, worldwide, it's been safe and getting safer all the time. I mean, the U.S. Nuclear Regulatory Commission is considered the gold standard on regulatory oversight of nuclear reactors. I don't think, given costs and time, that we're going to see any more large reactors built in this country, certainly. They are being built in China. They're being built around the world, and we can certainly play a part in developing the parts for those reactors. But I see the future for nuclear right now being in the small modular reactors.
Well, let's get to that in a moment. But first of all, give us a sense of the scope of it already. One of the things that I have learned is nuclear is actually one of the few things that really don't have emissions that can be taken to scale. I think something like 20% of energy in the United States is generated by it, 70% in France.
Right. And, you saw an example of what happens when you take nuclear offline. When California took the San Onofre nuclear reactor offline, their emissions went up and the cost of their energy went up. I mean, it was totally counter to everything that they were hoping to achieve, in my mind. And so what I've found over time is that if you have an opportunity to talk to people and answer their very real questions, I mean, it's normal to have questions about the safety, and you should ask them. But the answers are really good, and they're based on our history. You can prove that, in fact, these things work. And once you do that with people, they get much more comfortable with the idea of nuclear. It's just that for so long, it's been used as, frankly, a fundraiser a lot of times for the environmental groups. And we need to get the public to understand, particularly with the new small modular reactors that are built in a contained facility. They can be placed on site. They're much safer technology. They are a much safer way to produce the nuclear energy. So overall, they are really, I believe, have the potential to make a huge difference, particularly if you think about the rural parts of America where you're not on the grid or you're not close to the grid. You can take a small modular reactor and provide power for an entire town or an entire business. So they have a lot of potential there.
So let's pursue that question of safety, because that is on a lot of people's minds, without a doubt. And as you've mentioned, we've had some horrific instances. Is the issue with safety that people don't realize that actually the track record is quite good for nuclear, or is it technological developments such as you're referring to, small modular reactors?
No, I think it's because people just don't know. They don't understand. I mean, I get a lot of questions, I used to in the past, about, well, what about the spent rods? And first of all, I tell them from the time when we had 102 nuclear reactors in this country, and you took all those spent rods and you put them in one place, you'd fill up one football field to the height of the goalposts. They may have gotten slightly above that now because this was data from several years ago. But the point being, it's not this massive thing, this size of the state of Vermont, that people kind of have in their minds. And the other thing is that what's in those spent rods is 87 to 90% fissionable material, meaning unused energy. And in France and Japan, they figured out how to reprocess that and to get the energy out of those rods, rendering what you have as the quote unquote bad stuff down to 15%, let's say. And it can't be used in a nuclear weapon. So it's much easier to store, much less to store. You have a lot of unused power just sitting there in these spent rods. And we should be using that technology as well. And people have to understand, and when you explain it to them, you can't take one of these rods from a nuclear reactor and put it in a missile. It's not the same technology. It won't work that way. And the other thing that explained to them, because one of the most immediate issues that we had in this country was 3 Mile Island. And when that went down, the operators in the utility itself, in the reactor itself, were never exposed to high levels of radiation. And they've been tracked ever since. There were no releases into the community. And even those who were right there in the reactor had no adverse reaction to what happened. And in fact, it was because they overrode the system, really, that you had the partial meltdown. Fukushima Daiichi, that wasn't because of the earthquake, it was because of the tsunami. And that was because they had their backup power, their generator, located physically in the reactor building. After 9/11, our Nuclear Regulatory Commission said to our nuclear industry, you got to move those out. They cannot be co-located with the reactor itself. So that kind of thing can't happen here anymore.
Just this week, we saw an announcement of a deal to acquire Westinghouse Electric, basically on the premise that, in fact, we're going to have more nuclear energy. Do you anticipate that in the United States?
Well, I certainly hope we do, but it was, not even 10 years ago, I guess, there were 4 proposed reactors, 2 in Georgia and 2 in South Carolina, and we were very hopeful that those were going to come in on budget and on time, and they both ran over, and the utilities decided in each case that it just wasn't worth going forward. So it is a question of cost and regulatory hurdles, but you want to have those regulations in place because that's what protects the community and makes sure that things are safe and streamline how you approach them so that you make them go through all the hoops they have to for safety, but to put it to the front of the line to get this power online. The big problem we have, though, when you talk about all of this, is the grid itself. It's old. It needs to be revamped. It can't handle a lot of new power coming in. And that's one of the big challenges that seems to get overlooked a lot when we're talking about these issues. Again, you go back to small modular reactors, which can actually function on their own.
What about the grid? Are we investing in the grid? We have the bipartisan infrastructure bill. We also have the so-called Inflation Reduction Act, which had money in there as well. Is there money in there for the grid? Is it enough?
There is money in there for the grid. Whether it's enough or not, I doubt it. Hopefully, the money that's there will be spent in a way that ensures that nothing is wasted, because we need every penny of it. Certainly, every penny that's in there is needed to get the grid updated and to where it needs to be in order to accept the new power, whether it's from nuclear or renewables. I mean, they're going to depend on that as well.
That was Christine Todd Whitman, former governor of New Jersey and EPA administrator. Coming up, we take a look at what's in store the rest of the year on Wall Street Week on Bloomberg. This is a special Thanksgiving edition of Wall Street Week on Bloomberg. We have a little more than a month to go on Global Wall Street, and this is what's coming up, starting with Annabelle Drewlers in Hong Kong.
Thanks, David. Well, looking toward the end of the year in Asia, we're going to be focusing on key meetings in China. So the Central Economic Work Conference takes place around mid-December, and that's going to determine growth policies for 2023. And we could also get more of a sense of the priorities for the incoming leadership. He Feng is the man tipped to be the next economy czar, and he's already emphasized development as the party's top task. The question is also when China will start to reap the benefits of that pivot away from its harshest COVID policies. So data due in the coming days, that's going to give us clues on that, including PMI readings this week, and then we've got trade monthly activity numbers due later on. Central banks wise, well, the spotlight's definitely going to be on Japan. No big policy changes expected as yet. Governor Kuroda, of course, still at the helm there. However, inflation is now at a 4-decade high in the country. So the policymakers definitely under pressure to justify the decision to stick with easy settings. Australia's central bank also in focus, given the labour market there's looking fairly tight, but our Bloomberg intelligence team saying that's unlikely to sway officials from moving by more than 25 basis points.
The 22nd FIFA World Cup continues in Qatar, with the group stage concluding on December 2nd and the knockouts coming to a climax exactly a week before Christmas. Oil-producing nations, meanwhile, will gather for the final OPEC Plus meeting of the year in Vienna. That's on December 4th. And energy consumers across Europe will be keeping focus on the long-range weather forecast. With elevated gas and electricity prices, they'll be hoping a mild autumn continues into the winter.
With earnings season pretty much done and the shape of the new Congress now known, the focus for investors is squarely on macroeconomic conditions and how Fed policy reacts. Fed Chair Jerome Powell said after the FOMC meeting in November that interest rates would need to go higher than earlier projected, but the path may soon involve smaller hikes. That's the setup for the mid-December Fed decision, the last one of the year. That meeting will be preceded in the days prior by the monthly payrolls report and another reading on the Consumer Price Index. Spending trends will also remain in focus. We'll get two big reads on household incomes and purchases, with one release at the start of December and the other toward the end of the month. Sandwiched in between will be a big retail sales report that will include the time period for Black Friday. Corporate spending also is being watched as more companies announce layoffs, hiring freezes, as well as other cost-cutting measures as business growth slows. A report on orders for durable goods that drops 2 days before Christmas, which should provide a better read of industrial activity and potentially insights into the recent contraction in goods spending. David?
Thanks to Annabelle Drewlers, Danny Berger, and Romaine Bostic. Coming up, higher interest rates this year have really hit the real estate market hard. We get the overview from Tom Shapiro of GTIS Partners. That's next on this special Thanksgiving edition of Wall Street Week on Bloomberg. This is a special Thanksgiving edition of Wall Street Week. I'm David Weston. Real estate is never far from the mind of global Wall Street. In the United States, construction accounts for 3.9% of all GDP and 1.3% of the jobs. So when you start the year with mortgage rates around 3.3% and they reach 7% by the end of the year, it can make for a bit of a rough ride. One of those feeling the ride most directly is Tom Shapiro. He's co-founder and chief investment officer of GTS Partners. And he joined us on Wall Street Week to take us through some of the struggles, but also some high points for real estate adjusting to higher interest rates. First of all, I want to start with your take on where the housing market is right now. We've seen some slowing even this week with some new housing sales as well as existing housing sales.
Sure. First, thank you so much for having me on the show. Why don't I just give you a little anecdotal evidence of what we're seeing in the field right now? Our home sales are down about 15 to 20%, but that's a headline number. And, I think it'll be helpful to kind of dig a little bit deeper into that number. The reason, for the most part, it's down is because we can't deliver homes. We're still having tremendous supply chain issues. Also, we find that a lot of home builders are actually holding back on the number of homes they want to deliver. And that is for a couple of reasons. One, inflation, because costs keep going up and they don't know what it's going to actually cost to finish the house. And two, they want to ride up the home price appreciation. So I would say for the most part right now, while we see a 15 to 20% slowdown in sales year over year, a lot of that is because of other extraneous issues. It's more of a delivery issue than it's a demand issue. With that said, we're definitely starting to see a pullback. We're starting to have to go deeper into our wait lists, but every house at this point that we deliver in the markets we're in, we are selling. But I think we have to be careful about what we see, on a going forward basis, because definitely we're starting to see things slowing down.
That's a really helpful way of putting it up, because we're having those discussions about the overall economy. Is it supply? Is it demand? As I understand it, you've got a supply problem because of supply chain. People say that's going to go away. Is it going away in housing?
Well, it's not. I mean, we definitely have issues. We have problems getting trusses and windows and appliances. We're delivering homes with plywood windows at times. We're having all sorts of issues. And of course, the war in Ukraine and what's going on in China and the work stoppages there. The deliveries and transportation is an issue, and jobs are an issue, and trades are an issue. So it's gotten marginally better, but we still have tremendous supply chain issues. And look, if you look at how many houses we're delivering a year in total, this is all forms, it's about 1.2 million housing units a year, which is sort of in equilibrium.
So Tom, some of the issue can be on the demand side. At some point, we've heard about mortgage rates going up to 5.5%, something like that. So that must affect it to some extent. Are you seeing some effects for that? Because we also have the Fed is going to start selling off some of those mortgage-backed securities.
Yeah, for sure. I mean, look, the consumer's stretched. So why are they stretched? They're stretched because of inflation. So we have all sorts of issues. We have gas prices are more expensive, and we have the cost of food is more expensive. And of course, as you point out, mortgage rates are an issue. So the consumer is stretched, and that is certainly going to be an issue on a going forward basis on housing. But we are seeing, people taking less options. They're going to slightly smaller unit types, and they're renting. So we aren't necessarily seeing a slowdown at this point because of mortgage rates. But again, I think we have to be careful. I think, the crystal ball says it's going to get a lot worse. We're not seeing it today, but I think in the future we are going to see a slowdown. And as I mentioned, the 15 to 20% or so we're seeing year over year decline at this point isn't a demand issue. But I think we shouldn't kid ourselves that we are seeing it. Again, our traffic's down in a lot of our communities. It is starting to slow down. So I think we're going to start to see the slowdown come in the next couple of quarters.
When you say things are going to get worse, a lot of us go back to 2008, the last time we really thought hard about a housing crisis in this country. And there are some anecdotal incidents where it sort of feels like 2006, 2007, where people are outbidding each other for houses. They're going way above the asking price. Are there parallels with what happened in 2008?
It's a really, really good question. So why don't we go back in history? Because I think, we really have to analyze where did we end up in 08 and why did we end up there? So if you look back to 2005, we produced 2 million housing units. So in general, we produce 1.2 million households a year. What's a household? Your kid graduates college and moves into an apartment. A couple moves out of their parents' house and they take an apartment. There's a divorce, et cetera. And that creates a need for housing units. So against a total need of 1.2 million units, we produce 2. And then it did slow down because remember, after 05, even before the GFC, we started to have a housing slowdown. We still produced 1.5 million housing units. So we had a massive oversupply going into then a demand shock. So it was really the perfect storm. And that is why we ended up with the global financial crisis. So in those days, we just had a massive oversupply, and we had, and then we had demand just fall through the roof. Excuse me, fall through the floor. So that is why we ended up in the GFC, and that's why we ended up with a massive oversupply of housing. And at that point, people thought there'd be 8 or 9 million foreclosures. We actually didn't believe that number because fundamentally, we don't believe that if your house goes below your mortgage value by 5 or 10%, that people are going to walk away from the house. So we actually, at that point, started to buy housing lots. Why do we buy housing lots? They have tremendous convexity. If a home price goes down 10%, housing lots go down 20%. There's some point where if you're going to build a house that costs $200,000 that's worth $180,000, the lots are theoretically worthless, although of course they have some option value. Household formations also dropped through the floor, and that's because people doubled and tripled up, people moved into their parents' basements, there was such tremendous unemployment. So we started to see that at some point when the housing recovery happened and the economy started to recover, people would start to move out of those units and create households again. So that's why we did it, and we thought it was the best way to play the recovery.
That was Tom Shapiro, president and co-founder of GTIS Partners. Coming up, the tight labor market has continued throughout the year. We talked about the causes, including some that may not be going away anytime soon, with special Wall Street Week contributor Larry Summers of Harvard and with economist Melissa Kearney of the University of Maryland. That's next on this special Thanksgiving edition of Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Even as the markets and investors have struggled to come to grips with higher interest rates and less fiscal stimulus coming from the government, even as inflation has cut into wages and profits, the labor market this year has continued to be robust.
The labor market is still strong, but it requires a Fed that has a lot more skill and a lot more luck.
Some of that may be, as they say, transitory. The continued aftermath of the pandemic and a dramatic snapback in the economy. There are also more structural, longer forces at play. And we turn to our special contributor, Larry Summers of Harvard, and his fellow economist from Maryland, Melissa Kearney, to take us through some of those longer-term labor market issues. They joined us from the Aspen Economic Strategy Group's meeting in Colorado. Let's start with the question of where growth will come on the other side of whatever it is we're going through, because that's ultimately going to be the question here. I understand from economists like you, it comes from one of two sources, either more workers or more productivity. Are we going to get more workers?
We're looking at both fewer workers and lower productivity, as you know. So let me focus on the fewer workers aspect for a moment. The real issue, demographic issue facing the U.S. is we have a plummeting birth rate. And so total fertility in the U.S. is now below the level required to keep population growth constant. And so the issue here is that on average now, a woman in the U.S. is expected to have 1.65 children over her lifetime. So women used to have 3 kids, then it fell to 2. Women were having comfortably above 2 kids for many decades. With a fertility rate below 2, that means our population is going to age and it's not going to grow. And so eventually we're going to have a shrinking working age population.
Unless, Melissa, we have immigration.
That's right.
And that's why immigration, I think many of us at this conference feel is so very, very important. What's your sense of what economists would say, the politics apart, about the immigration policy?
Economists love immigration. We think immigration is a potential answer to our demographic challenges as well as our productivity innovation challenges. Since immigrants come in, they work, they're more likely than native-born Americans to be entrepreneurs and innovators. Of course, as you know, Larry, immigration rates are way down. So we used to bring in, as you know, 2016, we had as many as 1 million new people coming into the country every year. That number is now below 250,000. And so the combination of a declining native-born population and a decline in immigration portends even worse demographic challenges than if we were just facing one versus the other.
Let me see if I can do a little arithmetic based on what you said. From 1 million to 250,000.
Yeah.
So that's about 750,000 people a year. So that's about 0.5% of our workforce, maybe a little less. So 0.5% slower labor force growth over time can accumulate to something that is very large.
And if we go back to the birth rates, we have about 500,000 fewer babies being born a year than in the not distant past.
Melissa, if you, what would you say about this? Most people are scared that immigrants come and they take jobs for Americans, and that if there are more immigrants, then there aren't going to be as many jobs for Americans, or if there are jobs, because there's more competition, they're going to be paid less. And that's true whether the job people think is working at McDonald's or is working doing computer programming at Microsoft. How should people feel? Shouldn't they have this worry that they're going to be poorer if we take all the immigrants, just like they get hurt if we take a lot of trade from other countries where they have much lower wages?
So the reason economists are so bullish on immigration is because we have so much evidence that immigrants are good for the economy. They are good for most workers. But it is true that there are some groups in some places that will feel wage pressures. And I think the way we solve this issue is to make sure that we recognize the disparate impacts of certain groups. We recognize that low-wage workers in certain sectors might not experience the benefits, the overall benefits that immigrants bring to the economy, and we take steps to help them. I mean, it's not dissimilar to what we have to do with trade, too. You know, more imports is good for most people, but some people are harmed by it. We're going to see this, too, with the shift to a greener economy. Some people are going to lose their jobs, even though it's better for everyone. And so, I mean, I think acknowledging that some people feel and are harmed by this, but that's a small, concentrated group, and taking steps to address that allows us to do things that make the economy grow and be more productive.
Sorry, Melissa, I wanted to come back to fertility. Larry's pointed out a way in which economics, whether misperceived or not, may affect our willingness to have immigration. What about fertility? Are there economic causes for the reduction in fertility?
So the decline in U.S. fertility, and it's really being driven by a plummeting of birth rates since 2007. Births fell after the Great Recession. They haven't recovered. You can't point to any policy or economic factor that's changed since 2007. So sometimes people will say things like childcare has become more expensive, and if we just made childcare less expensive, people would return to having more than 2 kids. That is just not the case, right? There's nothing that easy that we could point to. And in fact, U.S. women now are just having births in the same way that women in other high-income countries have reduced their birth rates long before, in the 80s and 90s. So I don't think this is going to be easy to turn around. Lots of other countries have taken direct steps to try and incentivize people to have more kids. There's a lot of countries that have experimented with baby bonuses, a few $1,000s. Birth rates go up a little bit in the following year, but nothing like the 20% increase in fertility we would need to get back to replacement level.
Melissa, having an expert like you here, I can't resist stepping out of our mutual lane as economists to ask a question I suspect is on many people's minds. Do you think that the recent Supreme Court decision and the steps that are going to be taken in a number of states, do you think that's going to materially affect the number of births in the United States?
We do have estimates on this based on lots of data we have about how abortion restrictions lead to more birth rates. I expect there will be about 100,000 more births a year. This is not going to bring fertility rates back to where they were. This is going to mean that some women who wouldn't want to have a child now are going to. Since you raised the issue, I will say that this makes the imperative of doing more to support kids and low-income women in this country that much stronger.
That was special Wall Street Week contributor Larry Summers and University of Maryland professor of economics Melissa Kearney. Coming up, there's dust yet to settle from the regime shift to higher interest rates, specifically that surrounding the so-called zombie companies, with Sonja Gibbs of the Institute of International Finance. That's next on this special edition of Wall Street Week on Bloomberg. This is a special Thanksgiving edition of Wall Street Week. I'm David Weston. Getting money for free, or close to it, can be nice. It allows us to pursue hopes and dreams that we otherwise might not be able to afford, leading to investments that couldn't be made with higher hurdle rates.
I outline everything from community college block grants to aid to communities to reform of the earned income tax credit to support work. All of that is probably about $100 billion a year. That's real money.
But what happens when the music stops, or at least slows down a fair amount, as interest rates shoot up and the bankers and other lenders get out their sharp pencils? Then, as Warren Buffett famously said, we find out who's been swimming without their trunks. And at the front of the line are the so-called zombie companies, the ones who aren't throwing off enough cash to meet their interest payments, much less pay off their principal. Sonja Gibbs, managing director of the Institute of International Finance, joined us on Wall Street Week this year to take us through the problem and what it may mean for the rest of us. Let me start with those basic questions. What exactly is a zombie company, and how many of them are there out there?
First of all, to take a step back, what you need to think about is that over the past 10 or 15 years, global debt levels have skyrocketed. We've had very low interest rates. And for example, non-financial corporate debt around the world is now close to 100% of GDP. And that's more than double what it was a decade ago. So that's a very worrying backdrop. And so what we mean by zombie companies is a company that essentially has to borrow to keep going. They are highly leveraged, they're not growing very fast, their revenues are not up to par. And at the moment, they face a very difficult situation. You've got higher input costs, so your commodity prices are higher, wages are rising. At the same time, you don't earn enough revenue to cover all of these higher costs and your debt service. So if you have a ratio of revenues to interest costs that's 1 or less, if you can barely cover your debt service costs, we call you a zombie company. And it's a very good name. It's very evocative. And for how many? I mean, it's difficult to calculate, right? Because for a lot of firms that, for example, aren't publicly listed, the information might be less available. They might be smaller, non-public companies. But the Federal Reserve estimates that between 5 and 10% of U.S. firms fall into this category. I think it's also important to remember that this is not a static world. It's not once a zombie, always a zombie. Conditions change. And in fact, becoming a zombie company is a little bit cyclical in the sense that when times are good, maybe interest rates are low, growth is high, maybe you're not a zombie. But then, you know, bad things happen, pandemics happen, shocks happen, interest rates go up. And a company that was formerly doing reasonably well might suddenly fall into the zombie category.
So you mentioned the overall debt load, which is true certainly in the United States, and not just in the United States, in part because interest rates were so low. There are some very, very successful, healthy companies that loaded up on debt because it was so cheap. But whenever we've talked about this risk in the last few years, they said, don't worry, as long as interest rates are low, we're fine. It looks like those days may be on their way out. We're going to have higher interest rates. So what kind of pressures does that put on these zombie companies?
Well, I think it's a good analogy, right? It's all fine until it's not. And so you've had a kind of a confluence of factors that have hit pretty much at the same time. You had a pandemic which hit growth. You had a commodity price shock. You have rising inflation. You have higher interest rates. And you also have firms whose business models, for example, have been entirely changed by the pandemic. I mean, amongst the list of zombie companies, you might find a company like WeWork, you know, a company that has been very successful, but at the same time, the pandemic has changed a lot of things for that company. Carnival Cruise Lines is another good example of a type of company who's now in the zombie category, or some of the meme stocks, you know, AMC or GameStop. So these are really household names. And I think that the difficulty is, at a point in time when you've got wages rising, when you have higher input costs, these firms may not be able to borrow as much as they need to borrow to keep afloat.
Sonja, do you tend to find zombie companies concentrated in certain sectors or in certain size corporations?
So I think it's fair to say that the sectors that are worst off in terms of percentage of zombie firms are probably in manufacturing and in retail. And retail, of course, is an industry that's undergoing secular change over the long term as we move to sort of more online, less brick and mortar. I think there are underlying structural issues there in that sector in any case. But I think some of the companies that are hardest hit tend to be smaller firms. And if you think about a small company, they sort of inherently face greater credit risks than some of the larger, better established companies that have long-standing histories and track records in borrowing. They're, familiar to investors. Smaller companies have a harder time accessing funds, especially when borrowing conditions are difficult. And with some of these companies having fallen on hard times during the pandemic, there are estimates that suggest that in some cases as much as 25–30% of the small cap companies, especially if you include unlisted companies, could be falling into this sort of zombie trap.
I wonder, Sonja, about the larger effects on the economy. Obviously, we don't wish ill for any corporation, but there's going to be a lot of stress put on a lot of the companies you're describing right now. Insofar as that all gets sorted out, to use a euphemism perhaps, is there some benefit for the economy in redeploying the capital they represent into things that might be more productive than their enterprises?
I think we might want to think about this in a short-term and a long-term context. So in the short term, it is very helpful for the economy to keep these companies afloat. And you could think of the example of Japan here, which has spent over $800 billion since the pandemic hit to support its companies. So you avoid bankruptcy, you keep people employed, you keep these companies afloat. But there's a longer-term cost to be paid for that. Because when you think about it, money that's being spent to keep zombie companies afloat is money that could be more productively deployed elsewhere. You could put it into capital spending. You could put it into infrastructure. You could put it into new industries, new technologies, maybe in the ESG world or green technology that can really deliver a boost to productivity and growth. So it's kind of a foregone opportunity in that sense.
At the same time, for the reasons you described, and the example of Japan is a good one, it strikes me, there are political consequences of letting zombie companies go belly up.
Well, the politics of these things are always difficult, right? I mean, one of the conclusions that you can come to is that if you have a high proportion of zombie companies, if you have companies that you're worried about keeping afloat, there's political pressure to keep that going. The more that borrowing costs rise, the more that interest rates rise, the harder time these companies will have keeping going. So if you're in a world where inflation is rising and you have central banks having to make a very difficult balance between controlling inflation and supporting growth, which can involve supporting some of these less profitable companies, it's a rock and a hard place. Where do you draw the line?
That was Sonja Gibbs of the Institute of International Finance. That does it for this special Thanksgiving edition of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.